There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
So let's take a look at the Forex Factory calendar. ForexFactory.com, you always want to filter out and see only, in my opinion, the gray and red folders, and then take the date and move it to the next week. Okay. So we have German PMI. It should be interesting to see if this comes in hot. You do note that it is a bank holiday, right? Markets closed on Monday. In terms of the US, Forex markets, depending on the broker, are open. It is a bank holiday on Tuesday, so I think you'd rather, I don't know, unless some craziness heats up in the Ukraine area, should be a fairly tepid session tomorrow. Do note that we have, for any of you trading anything down under policy statements as well as press conferences, and then coming into the UK and the US later in the week, the core GDP and so forth. So do note this is the second to last week. And just remember, we finish on the 28th of February this particular year. And that's what, leap year every 4 years? I forget. So it goes to the 29th. I forget how that operates. So in any case, nothing, I don't know, nothing earth shattering unless we have geopolitical events, which could foreshadow that as well. Let's take a look also at, let's see, what do I want to do here? Minimize the screen. Cancel out of Forex. Let's take a look. I already showed that. Let's look at the markets here and see if maybe we can, a lot of times with this, actually just make the screen bigger. All right, so for those of you who don't know, this is the FinViz, although it is FinBiz because they try and rope you into $25 a month website here. I always start off some weeks reviewing some of this. I know a lot of you trade equities and options as well as MT4 based currencies on these types of indexes as well. So with the Dow, S&P, NASDAQ, Russell just represents the largest and most inefficient of the indexes, all the way down to a more efficient index, tech only, and NASDAQ, biotech, and some of the areas of technology, and then the smaller caps of the Russell 2000. So we could see we peaked out pretty much towards the beginning of the year in all the indexes, and we've been in a correction mode since. Biggest weakness has been both the NASDAQ, the market as a whole, not just the 100 top stocks, as well as the Russell 2000, have been weaker than the broaders. But you know, the weakness has been pretty much across the board as far as Japanese companies, as well as the euro and broader sectors of the DAX primarily. This doesn't show the 600, but the chart patterns look very similar to this. It looks like we've got some pretty key levels that are fairly well defined, as you can see underneath here, that certainly could be taken out. Obviously, geopolitical has typically been responsible for the rise in energy prices, albeit we've seen the pretty decent pullback actually of almost $5, because we're looking at, and I try to focus on daily charts, but you could certainly drop back to weeklies if you want to see a bigger picture. but that's the energy space. Gold, as you can see, finally, it's only taken like forever to break out. Hasn't seen these levels since last May and June, when we had rises of concerns about different variants coming out and COVID and lifting up. Now we have geopolitical tensions that I think are taking center stage, and we certainly could see this go up and test 1950, which would be a long-term breakout if we get above this point. It certainly, from a long-term chart, I know a lot of you don't trade gold, but this would be a breakout. Okay, so if we were to get above this 1950-ish area, we could absolutely rip all the way to the high. So for those of you looking for a quick run, I don't know if there's any triple or double levered ETFs out there that are just attached to gold, but you could certainly search Google for that and ride something up if there's a breakout. But typically in this level here, every time we've gotten close to this level, there's been some pretty significant rejection, and we've just built back into this long base that we've built out. So I could be a little bit early on that call. So I think that's pretty much it for metals. Let's go back to the broad market daily charts. Okay, so the interesting thing is that the space, if you will, for everything from the longer term bonds down to the short 2-year notes has seen a pretty significant price sell off, both from the 30-10 and the 5-year down to the 2. We've seen a little bit of a retrace, which more than likely will get sold. I think the thing that probably surprises some as well is that even though the Federal Reserve does need to move to curtail inflation, which is consistent even now, and in some cases areas getting worse in different sectors, I guess the market anticipated it would be significantly more sort of vicious cuts, kind of like those surprise 50 basis pointers overnight that we used to hear a lot about during the very beginning stages of the bubbleness that led us into 2008 financial crisis. So we'd routinely wake up with a surprise 50 basis points. Markets would be going crazy. And keep in mind, this is over 12 years ago. So many of you may not have seen markets at that particular point, but I was trading the futures markets almost exclusively back then, and equities. And it just wake up to the just complete mayhem in the futures markets. It's a very dangerous and knife-based space to be trading in when there's central bank action to the degree there was. Ultimately trying to stave off, but they rose too quickly, and everything in terms of asset prices had already continued a ridiculous inflation and levitation or bubbleishness, if you will, at that point. Thus, when things popped, the Fed was forced to keep dropping interest rates. And that's where the term quantitative easing came into play, as their open market operations did a complete 360. Now, that was a long time ago. Many of you have never been through that cycle. I keep bringing it up because I think it's important in a risk management discussion to understand what took place as a QT, possibly maybe replacing the QE, which I spoke at length about. Was it last Saturday? Is it Saturday before? But I watch them both. Pretty long discussion on how that sort of affects money supply, markets, interest rates. I mean, really the bottom line is if they start raising interest rates in the bonds markets, in terms of the price of the bonds, not the yields, but just the prices you're seeing across the top here, continue to go down, the yields will go up. So it makes it much more expensive if there's no action by the central bank to change any kind of interest rates, from everything from 30-year mortgage rates on a home to interest rates on the purchase of a vehicle or business loans, or a sort of trickles down into all the other sectors, thus it making more expensive to do basically everything. Now, as far as moving into currency land, what has taken place is really just a sideways, I don't know, trading, trending. I call it a balancing period. Some will just call it we're auctioning back and forth between a tighter high and low range. That has sort of precipitated all of these markets as we're trying to get some clarity about central banks globally, comments from different central banks as far as, and then obviously the Russia-Ukraine geo event, which may or may not materialize. So it's difficult to do any kind of forecasting. I'm trying to stay away from it right now because I think it does none of us any good. And quite frankly, if you're not comfortable with where this are and you're playing with capital you cannot afford to lose, I'd say don't do that. But I know not everybody's going to listen to that. But what I would say is that protecting your capital and being in cash is a position, right? So never force yourself to need to trade. Even though I know it's difficult, I think that one of the cool things that separates some of the best people in the world from the rest of the masses, I don't care what they do, especially in trading land, is they do understand in many cases, if not all, there always will be another opportunity that presents itself, right? So I think the problem, and this truly is a risk management discussion at the very highest level, because I don't care if you're a teenager stuck in a bad relationship, right? Or if you're, a new trader. I mean, it really doesn't matter. As I always say to my kids, there always is additional fish in the sea. Don't labor yourself or, create a mania surrounding something that is not working for you that you're trying to force. Because there's other opportunity out there, right? Whether it's trades, relationships, businesses, education, and you can always go back to the trough, if you will, right? Go back to school or go back to your trading notes, books, or whatever the particular case is. And it really just continues to surprise me over the decades that the vast majority of this planet, human beings, they don't understand that. And it affects, in many cases, a huge chunk of their life, right? They let some relationship completely wreck their head and their business and their life, right? And look, I'm not trying to be insensitive. I get it, especially when it comes to relationships, there's certain amounts of healing or emotions that need to be worked past. I don't know, maybe my insensitive bastard portion of me helps me a lot in this area. But I think it really behooves someone to just take a look at whatever the event is that's a negative, and try to spin it into a positive, right? If you didn't hear this expression in some form in the past, this is absolutely true. Your 90% of your life is shaped by how you react to the 10% of the crap that happens to you. So just remember that your reaction to it will shape your life much more than a lot of other factors that are part of it. And believe it or not, that is absolutely risk management from a human session, right? So get off my soapbox for the weekend. You can see all the prices are declining, so yields are rising in the notes area. Just the relationships between obviously the euro, we had a huge spike relation to a whole host of factors here, caused the opposite reactions in almost every other market, and now we're coming back to, I don't know, a level of I guess a level of balance between that. I call it auctioning in a tight balanced range. I'm not going to go into too much detail of that because I wanted to show the markets. I'm not going to go through any of these, but I will at least show the S&P. It's kind of what I talked about. It's down to the dollar. Kind of what you saw in the FinViz charts, but obviously this little more detailed trading view chart piece. And, I would expect possibly some crazy reaction if something bad goes happen in Ukraine or in other areas of monetary policy. It's just a quick chart in the euro. Talked a lot about these levels, so I'm not going to bore you guys with that right now. I just want to at least show the charts to you. Who knows what the heck's going to happen. This one has formed a tight base, though, US CAD. Same thing could be said with USJPY. Aussie US. Looks like we're probably going to break a little bit lower in this particular one on the Canadian. It looks like tight range. Many people trade that. Euro GBP for some of ours in Europe that asked me about this. You can see we're still inside the range. Euro yen. GBP NZD, which I haven't shown in a while. It's actually fallen into an upper balance area. Essentially trading sideways. Tight range here. Aussie New Zealand dollar. Let's take a look at the neo currency here. Notice the strength, if you will, or maybe a head fake at this point. The 73.28-ish area possibly could break out above that. I would imagine it would be a quick zipper up into the top of this region. So this whole 75, 70-ish area, if you're in any longer term trades and you're long this on the breakout, keep in mind this is a very nice, the problem with this very nice cup of handle pattern is that we have a lot of unstable geo events in front of us that can completely take center stage from what I would believe to be, now remember we got to close above this area, a pretty decent cup of handle pattern if you're not seeing the cup and then the handle. Ideally, as we break, you want to continue to see volumes increasing. More than likely, we're going to get a quick rip right up to this area. Lower risk trade. Unfortunately, it has the backdrop of a very high risk environment. I think that's everything I wanted to point out. Just a quick look at crypto. Everybody that gets emboldened as we rally sees a distribution take place or a sell-off like we've done. I think ultimately it's going to take us down to the 20K area. And keep in mind, we've got the hold on for dear lifers that are losing faith at this point. And at some point, if we get down to this, it's probably just going to blast through it. Don't catch a falling knife. Let it play out. More than likely, long-term support is going to be somewhere in that 20K area. Ideally, as I've talked about for almost 6 months in this, you're going to want to see that pattern play out for in balance, ideally for a period of time before it's worth getting back in. The problem with that in comparison to any other kind of assets chart pattern you'd look at is great. You know, the chart patterns and the breakouts are kind of, but this is all over the place. And it's, I think this is just more of a boom or bust. I prefer to wait for the bust and then try and ride it back up in the next boom, which more likely will happen. The question is, we just have no idea where it's going to shake out. If we do have a considerable equity sell-off this year, they're going to completely throw the baby out with the bathwater on this one. So just be real careful on that. If you're going in and trying to catch the falling knife, you know that I'm against it. But if you are taking small amounts of capital, maybe you do let the 20,000 area play out. Who knows? It could be wrong. You know, take a small amount in because it could very easily go back to its long-term area, which is right around that 5,000 to 7,000. In which case, I will absolutely be taking pop shot cracks at it down there, trying to build an accumulation. So I'll talk more about that if we were actually going to hit a point like that. I'd be much more interested at that level. Could be wrong. May hold and balance here and rocket back up to 68 in this value, in which case I was wrong. But I would rather see a much more fruitful bottoming pattern playing out, which we are not seeing here. This chart of Ethereum looks the same way. There's the Bitcoin ETF I was talking about. You can see this thing just looks the same way as well. Looks like it's getting some more activity. But these hold on for dear lifer guys, at some point, they're not going to hold on for dear life. They're going to just flat out bail. When they bail and the world falls apart in crypto, that's when I want to start looking. Not buying, just start looking. Start hunting for a basing pattern. Let's see what else. Yeah, I think that pretty much covers it. So do me a favor and just continue to communicate with all your teams, especially the explosive growth that we've seen in Europe. My hat's off to those guys. Do try and get all of your team plugged into your developers channel on Telegram in addition to mine. And hey, as I always say, risk management. Wish everybody a great week of trading. May the trades be with you. Steve Vetterl, off the mic.
There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.